Hi, I'm Jerry Bowyer. You're watching the Eagle Investing Network, which is a smart move on your part. A smarter move is to subscribe so you don't miss any of these. And a decent move is to share this with other people who could also use a refresher or even an introduction to finance, economics, and investing. All right. Speaking of investing, let's look at some investment data. This is a line chart. A line chart is made of lines. We're getting really basic here. A line chart is made of lines, and this is over time. So starting in 2002 to 2022, which is where we are when we're recording this. The different lines represent different investments. This is a corporate investment grade bond. What does that mean? Corporate means that these are bonds that are issued by corporations, not the federal government, like treasury bonds. So the corporations borrow money. They say, give me money, here's a promise. That promise is called a bond. All right, now down here, we have 10-year treasuries. This is how the federal government borrows money. The federal government says, give me money, here's a promise in the form of paper. And by the way, we're renting your money, so we're going to pay you rent on your money, and the rent on land is called rent. The rent on money is called interest. Same basic idea. All right, so let's go back to the data, and you already saw this if you watched my last video, and if you didn't, I would urge you to do so. This being the 10-year treasury yield, and we saw that this went up. People didn't want treasuries as much anymore. When they're scared, they want treasuries. So when they're scared, they're buying treasuries. And the more they buy treasuries, the more the price goes up. And the more the price goes up, the more the yield goes down. Because yield, it's just in the math. Yield is just the interest rate divided by the price. So if the price is going up, then that means your denominator is getting bigger, which means the ratio is getting smaller. Just like 1/4 is smaller than 1/2. Okay, so that's treasury. And what we've seen is that the pattern over, basically starting right about here, right kind of after the worst of the COVID, was that people were getting out of these bonds. So kind of maximum fear here to some degree. All right, so when they're getting out of these, when they're selling these, what are they buying? Well, what's going on here? Look at this. See, what's going on here is they're selling treasury bonds and they're buying, not consistently, there's ups and downs, and they're buying corporate bonds. So that's optimism. This is the absolute sure guarantee. Uncle Sam has never defaulted. He sort of has in the past, but let's leave that aside. He's never defaulted. He never will default. So that these kinds of bonds are considered very safe. So the fact is, when you are, in these, you want safety. When you're getting out of them, and you're buying corporate bonds, even though they're investment grade, it's better than, say, junk bonds. There's still some risk. So you're feeling like you're not worried about risk. So doesn't that make sense? From here, the COVID coma, when things were terrible, we didn't know what was going to happen, coming down to here with the recovery, it would make sense that people are buying more of these corporate bonds, driving down the yield. Now, let's make something a little easier. We're going to do the spread. Spread is just a way that people in finance talk about the difference between, say, two yields or two kinds of investment. So we're going to take the difference between these. By the way, this is inflation protected. I'm not going to deal with it now. Future video, we're going to look at when they're getting out of treasuries and getting into inflation protected. What does that mean? And were they right? But now we're going to look at the spread between these two. So let's go on and do that. So this is the spread between corporate bonds and government bonds. So the higher the spread, the more that's kind of a fear premium. See, the Great Recession, the COVID thing. And then when that's coming down, that's optimism. And then it kind of gets a little more pessimistic. And then as of April 2022, it's fairly optimistic. Now, let's get a little deeper into this, right? So we're going to rearrange these. These are in date order, and we're going to come back and we're going to rearrange these in dot order, and then we're going to rearrange the dots so that we actually have this spread: scared, not scared, or less scared. Arrogant even down over here. And terrified, remember that? Were you terrified? Well, markets were. And what we see here is there's a negative slope, which means the more scared markets are, as you're moving here, if you're moving along this line, as you're moving here, this is just get a little refresher here on linear algebra. As you're moving down this line, the X factor is going up. See, as you're moving along this line, down here, you're moving further there. And as you're moving along the line, what's happening here? The Y factor is going down. So that means there's a negative correlation between this and this. There's a negative correlation between fear and the next year of economic growth, which you would expect to work, right? If markets know something, and part of the idea here is that all of us know more than just some of us. If markets have insight, then that means you would expect that as the markets are reflecting more fear, I don't want corporate bonds anymore. Everyone's going to default. I want nice, safe treasuries. Well, in times like that, in the next year, the economy tends to not perform as well. So this really does know something. There really is information in this. Now, does it know everything? No, of course not. Otherwise, those dots would have been right there on the line. Let me put in a little extra advanced topic here. These spreads tend to represent not just growth fear, but specifically deflationary recession fear. Deflationary recession fear. So when you enter into a recession or stagnation, it's harder for corporations to pay back their loans because they're not as profitable when the economy slows down. But if you have inflation, inflation helps debtors. So the slowdown hurts the ability of companies to pay back the bonds, but the inflation helps them because they're paying back dollars that aren't worth as much. So when you have stagflation, this spread isn't actually so big. Corporate bonds do, not great, by no means great, but they don't do as badly as you would expect during stagflation because the stag hurts them, but the inflation helps them in terms of their ability to pay back. And I think the fact that this is showing a fair amount of optimism right now, about a 3% growth rate, I think that is really reflecting that there is really a slowdown as of the time that I'm talking to you. We just found out that we had a quarter of negative economic growth. There really is a slowdown, but it's probably an inflationary slowdown. So you have the headwind of the recession and or stagnation, but you have the tailwind of inflation, which I think makes this signal not entirely reliable if you don't take into account the inflation aspect, which is something we're going to look at next. We're going to do something very similar, but looking at inflation. I'm Jerry Bowyer, and this is the Eagle Investing Network. And you're going to hit subscribe if you haven't done so already. Thanks for listening.